use other assets when the market is up and when the market is down, instead of having to sell assets at their low point, take the loss for income, you can instead use your income from the cash value life insurance policies. Welcome back to the channel. This is Brady Watkins with Leverage Wealth Management. And today I want to go through a concept that's pretty important. I want to go through the flexibility on how you actually can take your income in these types of policies. So in order to do that, I'm going to share my screen and go through a few different scenarios that may be possible, that you may want to implement once you're in the distribution phase on these types of policies. And so what we're going to do is look at a few different illustrations so that you can see the flexibilities on how these policies work. So traditionally speaking, when you see an illustration, you are probably going to see this income of a flat amount. Okay, so we're showing a premium outlay where you would pay $100,000. The client's paying $100,000 a year for 10 years. And then at an income age, maybe at 60, they want to retire and they want to start taking out income. Well, this illustration shows that you can take out $150,000 every single year, and that goes forever, tax-free, with no risk at the market. Most illustrations are going to show you this flat number. And I think it's important to say that this is a projection, okay? This is not a guarantee. This kind of gives you a good idea of what the income could be. Kind of gets you in the ballpark of the income, gives you an idea of what the income could be. A safe window, and really this is more of a window because we're still, basing this projection off market performance. I would say a good window would be 15% plus or minus of the number that you see on the illustration. If the market, if we have good cooperation in the market and the market performs well, maybe you get 15% more than that. And vice versa. Maybe the market doesn't cooperate in this, 15-year stretch and you have to take out 15% less in income. Most of the time, you're going to see this level income. So while this number kind of gets you on the dance floor, oftentimes this is not how it plays out. Most clients don't take the same amount, and that's a terrible line, by the way. Most clients take out, different amounts each year, or maybe they, are seeing a big problem with this consistent income every year, and that would be with the $150,000 each year, you're losing purchasing power with the problem of inflation. And that is another flexibility that these types of policies can provide. You don't have to take out the same amount every year. In addition, if you want to kind of pace with inflation, you absolutely could do that. So here we are starting with a lower income and we are going up with inflation. Now, yes, this starts with a lower amount. You don't get to that 150 until age 70. But what you are doing is you are not losing purchasing power on the income that you are taking. And this kind of allows you to budget and kind of budget your expenses to make sure you're not having to account for the problem of inflation in a different vehicle. You are not losing purchasing power if we do it this way. And a lot of questions arise from showing this because a lot of people are going to say, hey, well, I hope I have that inflation rider that, they were showing on that one YouTube channel I watch. I wish I had that. Well, this is not some kind of rider. This is just a distribution strategy and tactic that you can implement every single year. The pros would be you don't lose purchasing power. The cons are maybe you are starting off taking less, but from a retirement plan, an income plan perspective, this would actually probably suit you better. And we've seen more people do this so that they can have predictable expenses paid and all of that than doing kind of the flat 150 each year. The third option, I think, is one of the best use cases that you can use and what we would suggest, we do suggest a lot of our clients to use, and that would be to utilize this type of vehicle, especially in the down years of the market. And there are so many different details and use cases just in this one strategy, but let's kind of just follow along with this illustration. So the client goes as planned, $100,000 a year in premiums for 10 years. The plan all along was to retire at the 15th year or his or her age 60. Let's say the first year we do start with that $150,000 in income, but let's say the next 4 years the market is doing really well, let's say exceptionally well, to where they don't need to take the income from this policy. And then in the 5th year of distribution, or maybe the 6th year, the market has a pullback or a correction. Well, there's nothing worse than selling your assets low when you need to count on it for income. So instead of selling assets low, you use your index universal life policy that cannot go backwards as an income stream for that year. And then let's say we repeat the process, $750,000 coming out 5 years down the road. And, maybe a lot of people don't actually need, $750,000 in 1 year to pay for expenses. But what if I told you you could use the IUL to pay for your expenses, take out the rest, and still use as dry powder to buy in the market dip? That is a really cool use case on the policies. And so the summary of this type of strategy would be to use other assets when the market is up and when the market is down, instead of having to sell assets at their low point, take the loss for income, you can instead use your income from the cash value life insurance policies. And what else that also does is allow you to feel the freedom to take more risk in other assets, knowing, you have this type of vehicle as a backup when the market's down, when you're, at a loss for the year. Instead of selling your positions, you use the policy funds here, and anything above and beyond what you need, you can use as dry powder to buy in at the market at a discount. So there's obviously a lot of other strategies that you could implement when you're taking out income with these IULs, but the point of the video is to go through just the flexibility of how to take income and when on these vehicles, because there is a huge use case to use them the right way and really the most efficient way. If you're in the process of looking for these types of vehicles and you want to know, are these a good fit for me or not, you should book a call with our team. We will be able to help give you enough information to make a good decision with your money. There should be a calendar link to book a call with our team down below, and we're looking forward to chatting with you then. Please subscribe to our channel to be on the lookout for new videos. Take care.